when we talk about market risk, we use volatility, and I found it interesting to represent it from a graphical perspective to really capture what it means. Because if you just hear standard deviation, it might sound or it might appear confusing at first. In reality, if you plot two curves, so you see here the green line and the red line, you can see what means standard deviation or variance. And in this case, both of those curves have the same average, the blue line, but the green line have its value that are closer to the average. And this means that its dispersion around the average is smaller. Therefore, if you were to, think that this is expected or actual return, then the expected return that you will get in the future, the ones that you don't know yet, you can tell that they will be more or less within this space, right? It's likely, given its past history, that it will not move too far from the average, so it's more predictable. Whereas the red line has had very strong movements around its average, so the dispersion is higher, so there is more uncertainty and therefore more risk. And this is how mentally you connect the mathematical formula of variance with the idea of volatility and risk. Now, small note, when you talk about sample, you have to divide it by n-1 for the variance, but you don't have to when we're talking about the entire population. This has to do with degree of freedom, but a different topic, and I invite you to deep dive into it on your own.